So much for taking time to visit this channel, and on this channel we talk about personal finance and investing. I would like to share my investment plan for 2024, but essentially I have six things that I like to focus on this year. Number one, avoiding high interest debt outside of a home mortgage. Number two, setting out my investment goals and adopting specific investing strategies. And number three, considering tax advantaged accounts as an investment vehicle, and also having diversified exchange traded funds portfolio, and also with high quality individual stocks and other conglomerates that I believe to be well managed. Number five, building an emergency fund beyond 6 months. And number six, considering real estate as a potential investment sector. So just to explain those 6 points, the first one, what I have seen is that in North America, credit cards can be high interest bearing, for example, as much as 20%. So I like to avoid using my credit card if I don't have the money. Of course, I like to use my credit card as long as I have the money to pay it off, right? So that is something that I want to just make sure I control my behavior. If I don't have the money, let's say to go on a vacation or to do something, I would rather wait than pay high interest rate, or find other ways to have the money to be able to afford that. So the key thing I have learned in investing is that it's very, very important to focus on also controlling one's behavior if you want to be successful. If you feel the urge of maybe just eating out, and I'm not saying it's bad, I mean, there are other options to cook at home, or maybe do overtime work or shift and then pay for that. So that's the kind of thinking that I want to make sure that I align with. Number two, I like to have a long-term time horizon, 20-30 years. So when I'm investing, I like to know that these businesses, they are the businesses that align with my values, and also I'm investing for the long haul. And in terms of my specific investment strategy, I like to invest my money in growth companies, in other words, that have a huge prospect, at least historically, and also that have potential to grow, like the technology sector and semiconductor sector. And also I like to invest in businesses that have solid value, in other words, value-based investing. But for things like short-term based needs for my cash, I would invest in treasury bills or guaranteed investment certificates. Let's say if I want to buy a house in a year or so, at least that would cushion me to inflation. At least as of 18 December, the inflation rate in Canada is 3.1%. So what that means is I just have to cushion myself from inflation by investing in those interest-bearing securities. Number three, I want to sit down with my tax accountant and also just understand how best to optimize my taxes. There are quite an array of accounts in Canada, like tax-free savings account, retirement savings account, first home buyers account, and understand that every dollar that I allocate towards investing, it has to yield the highest return. So basically, I have to know which ones should I focus on towards my investing, rather than just investing without an idea of optimizing the taxes. So that is very, very important, because taxes, they do lower the overall rate of return for investments. Number four, by having a diversified portfolio that is exchange traded funds, like I said, I like to invest in semiconductor sector. I want to closely look for those exchange traded funds like SOXX that have those holdings in that sector, and also broadly the S&P 500 that historically has been doing so well. In other words, they are the top 503 companies as of now that are capitalized in the United States, and mostly they are tech firms that actually have been constituting most of the valuation of the S&P 500. That is Meta, Apple, which is now worth over $3 trillion in market capitalization. And these ETFs, what it means, if I invest in the S&P 500, I have some exposure in those specific companies and different sectors like financials, consumer staples, and usually what happens, even if there's a recession, that is a major slowdown in the economic sectors, for at least 3 months, and companies can cut off, lay off people. It's diversified in itself. So I like doing that. But also in terms of individual companies, I like to understand businesses. I don't want to just invest in individual companies that I don't understand. At least it has to be in the top 1%, and they have to have consistent cash flows that have been increasing, and return on investment that is over 15%, and also good management, and also competitive advantage. So I like to invest in those quality businesses in Canada, in the US, and also other hedge funds like conglomerates like Berkshire Hathaway. I like to own part of my portfolio, Berkshire Hathaway, because it is a well diversified portfolio. There's insurance, there's Apple that constitutes 50% of Berkshire Hathaway Class B shares, and there's quite a diversified portfolio, even MasterCard and all these other companies that constitute the Berkshire Hathaway portfolio. So they also have a well run based on their rate of return over the past couple of years. It has consistently beat the S&P 500. So having those factors put into consideration, that's how I want to design my individual portfolio. And now I want to build my emergence fund beyond 6 months, because having that emergence fund that can cover the basic living expenses for up to a year, it means even if I lose a job, or maybe if there are drawdowns in the stock market or drops, if I have extra cash, then I can add without the stress that at some point maybe I may have to sell off some of the holdings that I hold for the long term in the market. So that is very, very important. It takes discipline. And last but not lastly, I want to also consider real estate trusts, and also accelerating down payment savings, because it's very, very important. Either way that I look at it, if I'm paying rent, the advantage of owning a house is that at least being in a mortgage is that if it appreciates in value, then I can take advantage of that capital appreciation. But also it's another sector that can actually help diversify my overall portfolio when I look at all those sectors. So that's it with regards to the plan that I have for 2024. Let me know what you think on your comments, and I would like to hear your comments as well, and questions as well. And don't forget to subscribe